Hey there, everyone. Today on the final bar, the NASDAQ bounces higher. The S&P touches 3180. Bit of a distribution going into the close, though. We'll look at how things played out at the end of the day. Bitcoin continues its bull run, pushing above the 31,000 level. Finally, today we're doing a live Q&A on the final bar. What charts, what indicators can we help you understand today? Ladies and gentlemen, this is the final bar. Hey there, everyone. Welcome to the final bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a rainy Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the best practices of technical analysis. Technical analysis is all about measuring the pulse of the market and using price and volume data to really measure that pulse, right? To focus on all the buy and sell decisions, the fear and greed, all the emotional impulses and reactions that investors have, and how price is a really good reflection of those shifts in sentiment. Arguably, a lot happening right now in the markets, and just in today's session, you saw a bit of a rally out of the open. By the end of the day, though, going into the close, a little bit of weakness here. The Dow was negative through the course of the day. The S&P actually pushing back to the downside, and that's after testing 4180, which is a key Fibonacci level. Now, today, as I mentioned, it's raining in Redmond, Washington. I was just at a conference in New Orleans, so shout out to the FinCon community over the last couple days. Had a really good trip back and a great time meeting a lot of other content creators in the financial space. And when people were asking about Seattle, I explained this time of year it really starts to rain pretty consistently from now until about April, although there's some great moments. It's kind of the rainy time of year. I would argue that sentiment and particularly seasonality is about understanding that sort of the normal weather, right? It tends to be this certain way in Redmond, Washington in October. But that doesn't mean you can't have a random sunny day that's a little warmer than normal and it feels like we're kind of back to the spring. And that's what you have to remember in these markets. Even though we understand the climate, even though we understand the weather predictions and what normally tends to happen in the certain seasons, it can be unpredictable and weather patterns can emerge and change very, very quickly. So let's focus on the evidence of the weather of the markets and focus on where we can find some sunshine in these rainy days in the market environment. Let's get to our market recap. We're going to have a shorter market recap. As a reminder, the chat is open. We'll do a live Q&A here in about 10 minutes, so get your questions in now. We will start at the top of the list and start answering questions from there. Before we get there, a poll question we asked you recently on our social media accounts and here on our YouTube channel. What do you think the Fed does at next week's meeting? As a reminder, Tuesday, Wednesday next week, that is the November meeting. Next opportunity for the Fed governors to raise rates. Also an opportunity for them to leave them the same. Now, only 2% of you bravely suggested that they would lower rates. I would say highly, if not impossible, highly unlikely to not remote possibility that happens. Given what we've seen, I would argue they keep rates the same or they raise them another 25 basis points. A quarter of you, about 1 in 4, suggesting that they raise rates next week. I would guess that rates are remaining the same, by the way. We'll have to see, right? I think that's a lot of the communication we've seen. It's not about necessarily what would happen at the November meeting. It's all about the possibility of raising rates. And what the Fed governors have been doing in recent weeks is leaving that door open, right? Leaving open the possibility that they can take additional action. What's interesting right now is as stocks start to sell off, as you see conditions start to deteriorate, raising rates at this point could certainly drop stocks even more aggressively than they have already. We'll have to see, right? We'll have to see certainly from that communication. I think the interview or the Q&A session with Powell after the meeting's announcements is where you really could get some volatility. Last time we sold off pretty good once investors kind of digested the message from Powell's comments. So we'll see what comes at next week's meeting. Let's get on to the market recap. We're going to start overall with the chart of the S&P 500 and see where things are at. But first, let's look at just the major averages and how they played out. It's interesting, as we are prepping for the show, I tell you what, hosting a closing bell show is a challenge. And I will tell you why it's a challenge. It's a lot of fun, and I find it incredibly enjoyable, especially because the markets are different every day. And even though there are trends and patterns that we revisit, something new is always happening. What's interesting is midday, right around lunchtime Eastern, the S&P is actually pushing higher, opened lower, but actually traded higher through the course of the day, got up to around 42.50, just over that. And so, midday, it actually felt like kind of a recovery day after Friday's deterioration. But by the end of the day, we kind of turned right back. That last hour of trading, which usually represents more institutional investors, ETF rebalancing, those sorts of things, quite a bit of distribution, right? And I think that is one of those telling factors, right? Most of the last hours over the last week and a half have been negative. I think occasionally we've moved higher, but for the most part, certainly since last Wednesday, it's been distribution. I think that tells you a lot about institutions kind of lightening up, would be my overall sense of what that represents. The S&P finished around 4217, so still above that 4200 level. We traded down to around 4180, but got above there, 4180, but got back above there, but still, again, selling off about 0.2% by the close. So still above 4200, but heading the wrong direction. The NASDAQ composite just pushed right above 13,000. On Friday session, we actually closed below that level, pushed back above it today. So the NASDAQ leading the way higher, but only up by about 0.3%. The Dow down about 0.6%. Just below 33K on that one. Mid caps and small caps both down quite a bit more. So the S&P 600 small cap index down 1%. We've talked about the lack of participation in small caps. I think a number of my recent guests have addressed that pretty well. And again, I like taking a step back from the day-to-day movements and just thinking about what messages the market is trying to communicate through price action. The fact that small caps are going down and the fact that they continue to underperform the mega caps just tells you, at least it tells me, if you think about what that means, that small caps are going down and mega cap communication services and technologies are going up, that means you're unwinding the risky bets like emerging technology and you're going into the very defensive bets of things like NVIDIA and Meta. Those are sort of your defensive Magnificent Seven types of names. That's the rotation I'm seeing right now. Investors kind of going in the fetal position, relatively speaking, of going to big and defensive positioning right now is how I would interpret that. The VIX actually coming off a little bit here, down about 1.3 points, so still above 20. The VIX spiked well above 20 on Friday, Thursday into Friday, coming off a bit, but still above that 20 level. And again, back of the envelope, VIX over 20 is elevated uncertainty, elevated fear, which most often coincides with a market in distribution. I would argue that's very much what we're seeing here in mid-late October of 2023. Now, interest rates actually came off through the course of the day today. The bond markets actually rallied. So you saw stocks slightly down, bonds moving higher, which means rates are coming down. The 30-year yield back below 5%, 10-year yield around 4.84, 5-year yield around 4.8% as well. So bond prices actually coming up. Stocks and bonds have been moving in similar fashions here recently, but today you're actually seeing stocks down, bonds higher. Dollar down by about 0.5%. Not a huge move, but certainly not going higher. Commodities for the most part in the red, although copper prices, natural gas were up a little bit. Gold and silver down, right? So gold was down about 1/3%. Silver prices down 1.6%. We talked about the GLD last week a number of times, and I still think there's an emerging trend here. Gold, spot gold, really in the neighborhood of all-time highs. That would be around $2,100 an ounce. We're not there, but we're certainly starting to improve here. So a bit of a pullback day, and I would look through the course of this day. If you do see conditions in the Middle East continue to deteriorate, which over the weekend I don't think we had any alleviation of those conditions, certainly seems to be progressing in a way that conditions are getting worse over there. The general takeaways you would think is probably move to more defensive positioning. Bonds, gold would be logical places that I would expect assets to rotate. You're not seeing that on gold today. Certainly seeing that in the bond markets. Crude oil prices actually coming off today. One of the biggest news events today was Chevron buying Hess, two mega cap names in the energy space. Both of those not moving up on that news, unfortunately. They're both kind of digesting it to the downside. Lower crude oil prices, I think, outweighing any benefit of that proposed merger and what that might mean for the energy sector. Finally, cryptocurrencies, a lot of green here. Bitcoin continuing to press to the upside, up almost 5%. Ethereum moving higher as well, over 1,700. That's up 2.6%. And others you can see all in the on the green as well, from a little bit to a lot. So Bitcoin now above 31,000. It's been a while since we've been up to that point. We're going to look at a chart of the S&P, then we're going to go to Bitcoin as well, because I think you have to see how we've actually followed through that breakout to the upside. Finally, looking at sectors, only 3 of the S&P sectors finishing in the green. There were others that were up there above the zero line, but as the day progressed, there's sort of more red and more green. By the way, this is one of those really cool, simple visualizations that I like on StockCharts on the dashboard, which is something I have up most of the day on one of my monitors in my office. I always like to glance at, and I usually have this up just to look at the major averages and where they're at. I'm often glancing down here mainly to see which stocks are moving to the upside and the downside in the S&P, just thinking about what actionable themes I want to be aware of. But I'm then often glancing to the upper right and looking at the sector summary. And you can customize this to a degree. Just click on the little lines, the more button in any of those objects to tweak them. But I love the red and green bars on the far right side here. It's very simply just doing a graphical representation of the percent change from yesterday's or the previous close to today's close. But earlier in the day, it was more green than red. As the day progressed, you saw sectors go below the zero line and go from positive to negative on the day. So by the end of the day, it's more negative sectors than positive. And just a glance randomly during the day to see how much green and red, just a simple visual cue that helps you understand how the day's progressing. I love those sorts of visual representations that have some good data behind them. So the only three sectors positive: XLC, communication services, the best, up 0.5%. Consumer discretionary technology just finished slightly above the zero level. On the downside, energy on weaker crude oil prices getting hurt, down 1.6%. Materials, number two from the bottom, down 1.1%. Real estate and utilities, two pretty defensive sectors, down 0.8% to wrap up the bottom of the list. Let's go to the daily chart of the S&P 500, see how things played out. So again, another lower low. So if you start the clock, let's see, Friday, Thursday, Wednesday, if you start the clock on Tuesday of last week, starting on Monday really, Tuesday, Wednesday, Thursday, Friday, now today, every day we have made a lower low than the previous close. Every day we've made a lower high than the previous day. That is a market, certainly in the short term, that is in distribution. Every day when there's an opportunity for buyers to come in, buy in on that weakness and put it higher, it's not happened. And up until today, every one of these other days, you've closed down at the lows of the day. So Wednesday, Thursday, Friday, really distribution. Today, a little bit of buying. But you can see this range here. We actually finished kind of mid-range for the day. We did close again below the 200-day moving average. So when I'm looking at Friday's session, we closed below the 200-day. One of the comments I made was, all right, do we get that follow-through day on Monday? Today, I would say we have gotten that follow-through day. We remained below the 200-day moving average. We traded slightly above it, but closed back below it. So we're right at 4180 at this point. That was the intraday low, was kind of right there. I would argue we hold 4180. That is the last level. But overall, I'm inclined to assume that does not hold based on the distribution I've seen from Wednesday, Thursday, Friday into today. I think the major trend remains lower. We've now made another lower low. So we're in a pattern of lower highs and lower lows. Charles Dow would not hesitate. Were he alive today looking at StockCharts, which I'm sure he would be using it, of course, as a superior charting platform, but he would probably see that as a clear stepwise motion to the downside. That was Charles Dow's foundation of his work, was defining trends, and I think we've confirmed that downtrend. The momentum characteristics remain negative. The breadth conditions certainly nowhere but negative as well. There are a number of things we can talk about. Some of the things we highlighted on the show on Friday. I would just, if you're thinking about what the breadth conditions mean and what charts to look at, highs versus lows, very much favoring lows. And this is new 52-week highs and lows. In the middle panel there at the bottom is the New York Stock Exchange. The bottom panel is just the S&P 500, so looking more at the large cap space. But look at how big these red bars are and how the green bars have kind of evaporated. So no real stocks, or very, very few, a minimal number making a new 52-week high today. Pretty much everything coming off of those highs. And there are stocks definitely making a new 52-week low. The net difference of new highs to new lows, I think, is what's most pressing here. Starting the clock at the end of August, there has been a grand total of one trading day where there have been more 52-week highs than new 52-week lows on the New York Stock Exchange. That is a market going down with the breadth conditions really pressing to the downside. We've talked about a number of breadth indicators as well. By the way, on Thursday's show, if I remember right, we did a special segment called Banking on Breadth where we dug into some of those in a lot more detail. So if you missed that episode, I would go back to Thursday's show, go through those breadth conditions, because we went through some of the other charts here in my breadth chart list again, and most of them, if not all of them, really confirming that move to the downside. Let's go quickly to the chart of Bitcoin. I suggested there are some good things to talk about there. Here's the chart of Bitcoin. We're at a new high here. I mean, we are testing a new 52-week high today. And what a cool thing for Bitcoin, because we're down here at 25,000. I'm having people asking me, where's the bottom? Is it 20,000? Are we going to retest the lows? That was the level of negative sentiment that I was feeling at that point. that was when we really started to sort of firm up on these levels. The Fibonacci level around 25,000, that is, ended up lining up beautifully with the June low. So as we came back down there, that seemed like a really reasonable place for Bitcoin to bottom out. It did it. We then rallied off of there, higher highs, higher lows. That persisted over the weekend and really accelerated through the course of the day today. Earlier today, we were down around 30,000. We're now pushing above 31,000, almost to 31,500, continuing to accelerate. The RSI is extremely overbought. And if you look back at the last time that happened, that was in January of 2023. So before you say, hold on, Bitcoin's overbought, isn't that bad? The answer is no, especially when it gets above 80. That's what we call extremely overbought. We used to call that in my Fidelity days the good overbought. That means things are pushing to the upside in a big way, probably much further upside momentum. So I think the chart of Bitcoin has gotten less bearish and now all of a sudden more and more constructive as we retest those previous highs. I think there's further upside maybe to be had there. A lot of earnings that we'll get through the course of the week this week, but we're going to wrap up the market recap so we can get to the live Q&A. A couple quick announcements before we do so, by the way. As we get to the Q&A, as a reminder, it is open now, so get your questions in. We're going to start at the top of the chat and go through as many questions as we can with the remaining time in the show. Get your questions in. Any questions we don't get to today, by the way, we will put in the Final Bar mailbag. We'll do a mailbag show, I think, on Friday of this week, and maybe we can get to some of these questions we don't have time for today. You can also email us your questions at thefinalbar@stockcharts.com, on Twitter or X. Just tag us in a comment at FinalBarSCTV. Also to let you know, I have a free webinar coming up tomorrow called Another October Low, ? And there's a question mark on there for a reason. I'm not sure we're going to have it. I'm actually thinking there could be some really good parallels between 2023 and 2018. That was actually a year where we sold off in October and November. We actually bottomed out in mid-December. We'll look at what happened there, look at some of the signals that could have helped us navigate that year, and think about how we can bring those indicators to bear here in October and November of 2023. To sign up for that free event coming up tomorrow, 1 p.m. Eastern, go to marketmisbehavior.com/October-low. Would love to have you join me there. And again, that's at 1 p.m. Eastern, 10 a.m. Pacific. Let us get to the live Q&A, and thanks again for getting your questions in. We'll start with the top of the list. Acorn asks, how to explain the bullish divergence on Friday with the NAAIM index? Interesting question. I'm not sure exactly where we're going there. I'll bring it up. So the NAAIM exposure index, we talked about this indicator, I think it was on Friday's show, if I remember right, because what happened was the NAAIM exposure index actually pushed higher. Here, let me bring this down here. Oh yeah, I have it at the, let's put it there. I just like to show where the current level is relative to where we've been. So right now, and this is as of Friday's data, if I remember right, it's at 67%. So what this is a survey of money managers, and again, it's the National Association of Active Investment Managers, and they're asked what their exposure is to equities. And you can actually say as high as 200% long and all the way down to 200% short. So it's a pretty cool spread from strength to weakness. It comes in at 67%. One of the things we pointed out was over the last couple of weeks, as stocks have been selling off, you're actually seeing the NAAIM exposure index rally. And I think that's what you're talking about is on Friday, stocks selling off really through the course of last week, the NAAIM exposure index actually pushing higher. Tony Dwyer, who's a frequent StockCharts TV guest and has been on the show here. Hopefully we can I actually think we're going to get him on here very soon if I remember right, but I don't have the guest list in front of me. But I know when we've talked to Tony, we have this indicator has come out. He actually sent out a note last week talking about the increase in the NAAIM exposure index. What his suggestion is that could be money managers in this survey treating the weakness as an opportunity to accumulate. And I think that's a really interesting way to think about what the NAAIM exposure index represents. And really, if you think about those are most likely more long-term investors would be my guess. I don't know a lot about the demographics of the respondents there, but assuming that they're a little more medium-term, longer-term, what that is telling you is that investors, longer-term investors buying into the weakness in price here, I don't disagree with that, right? And there's a reason why in retirement accounts that I manage, I have a lot of equities in there because I'm assuming that weakness now will probably play out beautifully down the road as long as your runway is long enough. Weakness on the short term is a great opportunity. At Fidelity, portfolio managers would often say this is a chance to buy great companies at a discount. So thinking of it that way, super helpful. Now, if you're more trading in the short term, medium term, I would say the weakness is pretty strong. The opportunity, the potential to go even further is very much there. One of the headlines in the Wall Street Journal today, and I'm not making this up, I should have brought it up, but it was something like, the chances of another Black Monday type of move. And I don't think they were implying necessarily today Black Monday, but suggesting the conditions are there with a hawkish Fed, with geopolitical concerns, with a market that's already starting to rotate lower. We're a bad headline away from the market really dropping very aggressively. And again, I don't think that's a definite. I don't think that's going to happen. I can't tell you that's going to happen with some sort of crystal ball, but I would say there's a risk of that sort of event. There's a non-zero risk. So thinking now about how to plan for that downside, and then I would argue if you do get that acceleration, if you have a long enough runway, beautiful opportunity probably to get in. If you think about going, looking back, buying in October of 1987 would have been a pretty decent bet after that initial drop. So that is what I would argue the comparison between the S&P and the NAAIM exposure index. And again, there's often a delay too between the survey respondents and the day-to-day movements in stocks. You have to remember that as well. Let's see, Matrix of Compassion. I love that name. Thanks for your time and expertise. You're very welcome. Happy to do it, and enjoying very much doing the show and getting your questions. Marty asks, what are your thoughts on hidden bullish and hidden bearish divergences? What indicator or indicators will complement trading divergences? Interesting question. I don't know what you're referring to in terms of hidden bullish and hidden bearish divergences. If you want to go in the chat and give me more detail about exactly what you mean there, I can try to maybe address it in more specific terms. But I would say divergences are incredibly meaningful. And this is one of the things we talked about. Actually, I put it on a YouTube video on my channel called Market Misbehavior, I think a week or two ago, on leading versus lagging indicators. I think RSI is one of those indicators that has leading qualities and also lagging qualities, right? A leading indicator is something that anticipates something is going to happen, right? The conditions right now remind me of similar market tops or similar market bottoms. So you're not necessarily seeing it happen just yet. Your price is still going in the same direction, but it's showing some similarities to previous tops and bottoms. I think RSI is great for that, and divergences are one of the better ways to use that indicator because it tells you the trend is continuing, but the momentum is changing. There are some stocks that I could think of that are, I'm thinking of something like, I'm going back to my bread and butter charts here, like an Alphabet, right? Keeps making higher highs, but look at how the momentum on every new high has been weaker. So that, and the most pressing, or the most convincing divergence was here in May and June, right? Look at the May into June highs and the RSI sloping downward. So that pattern of divergence, the price is still going up, so the trend is still up, but the momentum is changing. The momentum is getting weaker, and that often suggests we may be nearing a top. To get to the rest of your question, which is what indicators can you use to complement it, I would argue that's your leading indicator. So combine some lagging indicators that would confirm, okay, that was a top. Now things are getting really bad. With something like like Alphabet, for my time frame, which is a little more medium term, longer term, I often look at the 50-day moving average, right? You see higher highs in price. When we pull back, do we hold that 50-day? And holding that 50-day would tell me, okay, it's probably not getting that bad. We're probably still in an uptrend. I would use indicators like PPO, MACD. Those are indicators which are basically a lagging indicator that would confirm. So the divergence would suggest the top is coming. The PPO giving a sell signal would say, okay, the top has now occurred and we're going lower. And I don't have the PPO indicator on here, but that's easy to fix. Look at that same time period, right? So here you have the bearish divergence telling you things are getting worse. And look how the PPO indicator kind of trades a little bit during that period, kind of toward the end as we're going into that new high. You're seeing the PPO rotate lower. So what that tells you is actually the moving averages that you're not showing here are actually getting a more negative sign. So that confirms that divergence and tells you the short-term trend is now lower. Then sort of gives you a supplemental buy signal there in July after we made a new low and price started to rotate higher. So that combination of something like RSI as a leading indicator, something like MACD or PPO as a lagging indicator, is a combination I found pretty helpful. I would think about that. And again, the video that I mentioned could be good to give you some other ideas as well. Great question there, by the way. Let's see. LG says, finally, fundamentals are dominating the AI and free printing money bubble. I don't disagree with your non-question. That's more of a statement. But if the answer is yes or no, I would say yes. It's so funny. As the market's going higher, we're often asked, and I'm often asked by media outlets outside of StockCharts TV, what's causing this? And you'd be amazed at how often they ask for very precise things. All right, this stock just went up $2. What caused it? And it's funny. I mean, my initial reaction is kind of laugh inside my head because it's laughable that we would try to attribute one move to something, right? Now sometimes it's pretty obvious, right? If there is a full war that occurs in Israel and Gaza and all of that, stocks will sell off very quickly, and you can probably attribute it to the headline that comes out that says tanks are crossing the border. Like that would be very easy, but on an individual stock during a random day, it is really hard to know what's going on. Sometimes it could be just a combination of more buyers or sellers. It could be just what they usually call they write off as a technical move, which is there's no great fundamental story, it just kind of happens. So I would argue that you could certainly attribute the unusual strength in AI companies as this sort of, ChatGPT comes out, all of a sudden all we're talking about are AI tools. I just came from this conference in New Orleans called FinCon where it's all content creators. There was a lot of AI discussion talking about writing blogs completely from AI, uploading a YouTube video and it writes an article and pulls out social media posts just from the audio alone, or a podcast or something. That's pretty powerful, and I would say the capabilities of those sorts of things are promising. Does that mean that NVIDIA is a buy today because that's something ChatGPT can give you? I don't know about that, and I think that was where you had a disconnect between fundamentals and companies' ability to grow earnings with the long-term prospects of what the technology has. Fantastic book. If everything I just said, you were like, oh, that's interesting, this question resonates with you, there's a book by John Markman, who we interviewed at ChartCon, which is our last StockCharts conference last year. Had a really cool fireside chat with John Markman. He wrote a book called Fast Forward Investing. Brilliant read because it talks all about things like AI, driverless vehicles, and those sorts of things, the promise of the technology, but how that relates to investability today. Great technologies don't mean a great stock at the moment. So combining those themes with more rigorous fundamental analysis of what the companies are and thinking about where the opportunities could be over time, I think that's a great way to think about something like AI. So John Markman, big thumbs up on that one. Next question, Matrix of Compassion question, how likely is it that the S&P fills its nearest downside gaps at 40.82, 40.30, 37.39? Do you factor unfilled gaps in your analysis? Love the gap question, and I love the precision of your question. You're hitting penny, like to the penny, you're giving me the quote on the S&P 500. So basically what you're saying is you're looking to the left and you're thinking about some of these gaps. So like 40.82 would be right around here. I'm guessing you're looking at like this gap back here. Like this would be maybe 40.82. I would imagine there. It's hard to really see what gaps I might be looking at here. Let's see, where else were you saying? Oh yeah, 40.30 would be like down in this range. These are like this one, and then what else? 37.39. That's all the way down here. So, how important are unfilled gaps? So, is a gap from March something to pay attention to in October? I would argue no. Now, there are others of my peers in the industry who would say, of course, all you need to do is draw a big line away from these unfilled gaps. I would tell you, having spent a lot of time with a lot of traders and a lot of investors, is this unfilled gap still something you'd be paying attention to? I hope not, because I think at this point, we're in a totally different regime. I think gaps have a shelf life. What's the definite time of the shelf life? I would say it's as long as there are not other more current levels or signals that kind of become more important. So, an example of where a gap makes a ton of sense, this one right here. More recently on the S&P, right? The gap lower, we trade down, we trade right up. I don't think it's a mistake that we trade right up to this gap, which remains unfilled on the way down. If we'd rally again, you better believe I would think this is a huge resistance level. So now that I would argue the major trend is down, if we do go higher, I think you have a really clear, very obvious level of potential resistance, which was this unfilled gap, the one that was tested and actually retraced to here in October. I think until we get back above 4,400, which would complete that, I think this market is going down. I think it's in a clear downtrend. So that has meaning. A gap back here, I would argue not as much that's meaningful. Now, it's hard for me to give you a time frame, like it's good for 30 bars or something, because I think it depends on the dynamics of the chart and how things are fluctuating. But that is how I would think of the gaps on the S&P bar chart. If you're looking back here in like the first quarter or further to the left, I would not put a lot of value on that. I would think more recent gaps, where if you look at the current price and look to the left and it stands out, that would tell me that it's pretty meaningful. Let's see. What do you think of Renko charts, Tom? You've had a number of questions on Renko charts. How meaningful are those? Renko charts are part of a group of what I would group in the type of Japanese analytics charting platforms. Very less common here in the U.S., but if you travel to Asia, particularly Japan, you will find a lot of people super intrigued by these patterns. And I've spent not a lot of time with Japanese banks based in the New York area, which you walk in onto these trading floors and it's like you're walking into a firm in Tokyo. I mean, it's literally a little Japanese embassy of culture there. And I've seen candlestick charting and Ichimoku charting, Renko charts, and all of those sorts of traditional measures. Less common here in the US, but very common in Japan. I've traveled to Tokyo a number of times, and I would say similar experiences. They're very widely followed in other parts of the world. What's cool about Renko charts is I would argue it's sort of like a point and figure chart where it attempts to get noise out of it. So are they interesting? Yes. Do I use them and think I should probably use them more often? Yes. Do I use them every day or very often? No, and that's the thing that I have. I have a rainy day list, which again, I've joked before here in Seattle, you'd think my rainy day list gets used a lot more often with how many rainy days we have, but I don't, and that is on my list to think about how I coordinate. The challenge I have with Renko charts and other charts like that is because you can't use them overlaid on a regular bar chart, a regular chart. It's a totally different structure. That's why I use point and figure charts a little less often. I do use candle charts often because it's easy to take a bar chart and just make it a candle chart, and that's why I think it's pretty helpful. So I totally appreciate that you're using Renko charts, and I would say for things like a big picture trend view, for things like if you're trying to look at highs and lows and just whether there's a good breakout or not. If you're looking at a structure for the market, I think Renko charts are very good. Same reason I like point and figure charts because the breakouts are very clear. So I would agree that that's a valuable thing. It's just not something that I use that often, but thanks for asking about those. Let's see. Let's see, a follow-up question here. Boy, this is oh yeah, I see. Yeah, okay, so I got a little more clarity on the hidden divergences, hidden bullish and hidden bearish divergences. Let's see, price making a higher low. Oh, I see what you're saying. Yeah, thanks, Marty, for clarifying. Hidden bullish divergence is price making a higher low, but the RSI is making a lower low. I get what you mean. So no, I don't use that a whole lot. I don't think those are widely followed. I would tell you they're not widely followed. What I like about divergences, they jump off the chart, right? It's really easy to see higher highs in price, lower peaks in momentum, and that makes sense. That intuitively makes sense. Where you have higher highs in price, you have weaker momentum, and I think that also I like indicators that you can explain because of a behavioral phenomenon, right? At the end of a rally, investors start to take profits, investors start to get nervous, investors start to unwind position, and that's what would cause weaker momentum. A lack of buyers, is what causes a trend to exhaust. Something like a hidden divergence, and now I get what you're talking about. Less common. I have heard people talk about in the currency markets, which is not an area that I focus on primarily. I have heard people talk about hidden divergences being much more common in that area, so that might be something. I'll make a note, by the way, to talk about some of my contacts that trade more FX primarily and see if I can get any more color for you. If I do get something, I'll share it on a future show. Happy to do it. Let's see. Yeah, NVIDIA, follow up. NVIDIA way ahead. I totally agree what you're suggesting, Captain Price. Way ahead of the fundamentals. What you have to remember is those AI-related names that rallied, it was not because of the fundamental analysis you would have learned in an MBA program. It was pure emotion. I mean, if you go back to Martin Pring's book on investment psychology, or any of the books on irrational exuberance kind of books, which are just brilliant about talking about the left side of a bubble and how it actually plays out. Manias, Panics, and Crashes by Kindleberger. Those sorts of books are fantastic to read because those things, right? Bubble characteristics, crashes, they have happened many times before. They will happen many times in the future because we get really, as an investor community, we get really excited about something and then we push it way above the reasonable valuation for that thesis. And I would argue that AI trade certainly leaned out way beyond its skis. I would not disagree with that in a second. All right, let's see. So if, okay, we got a number of questions. We got a whole convo happening in the chat, which I absolutely love, you guys. Thanks for doing that. Let's see with the Renko questions. Totally agree. And is it a confirmation of Elliot Wave? That is something I have heard some relationship with, and I would say, yeah, what Renko charts can be very good on is actually just thinking about the structure. And when I'm talking about market structure, it could be a wave structure, it could be patterns. It's anything that helps you look at the price action and sort of understand how the movements, how the peaks and valleys are related. So something like Renko charts can be pretty good for that. Let's see. So if MACD is lower than previous levels, is that a sign of a weaker move? Yeah, that was going back to a question we had here. Yeah. So what I would tell you is when I'm thinking about using MACD or PPO in relationship to something like RSI. RSI is a momentum indicator, so it's trying to look at a move and think about the strength behind those moves. Something like MACD or PPO is lagging behind it. Now, so it's really confirming when the trend has reversed. So I tend to use this very simply. I'm looking for sell signals where the MACD line crosses down through the signal line. A buy signal would be when the MACD line crosses up through the signal line. This is the PPO indicator, but same as MACD. I mean, the interpretation is the same, just the calcs are a little bit differently. So most recently here on Alphabet, you're actually getting a sell signal from the MACD indicator, the PPO indicator, suggesting we're now in a negative rotation. But I'll tell you the same thing on Alphabet. And this is where we'll have to wrap the Q&A. When I'm looking at this stock, right, the RSI has gotten weaker. Every new high has been lower momentum. That's not encouraging. The PPO or the MACD indicator just giving another sell signal, suggesting we're in a downside rotation. Previous conditions like that, we have found support at the 50-day moving average. So I think the real benefit of technical analysis is seeing the structure in a particular chart. Alphabet is in an uptrend of higher highs and higher lows. Things like the divergence, things like the PPO sell signal, all tell you we are in a position where we may be breaking down, but price is what's most important. That's why I think of all these indicators as confirmational. They're not necessarily the main thing I would look at. I would never buy a stock based on its RSI without looking at the price. The RSI tells me something about the conditions behind the price movements, but at the end of the day, I'm going to want to look at this. We hold an ascending 50-day moving average. The chart is still bullish. We undercut the previous swing low. The chart is clearly bearish. So recognizing what the price does, that's the most important signal of all to follow. Great questions, great conversation. I appreciate how you guys are helping. Makes me feel good about Final Bar Nation with a little collaboration there. We'll keep these going and keep them coming. Thanks again for participating in the live Q&A. Got to wrap the show and go to the 3 in 3. 3 charts in 3 minutes to tell the story of this market environment. Here, folks, is chart number 1. We're looking at the bullish percent index. I have to tell you, we are back below that oversold level. And you really don't use the terms overbought and oversold. I'm doing it for simplicity, but think of the bullish percent index as kind of an RSI for the broader market based on breadth instead of momentum. We went below the 30% level back here in first week in October, and we traded back above there. We highlighted that in green because when the indicator goes below 0 and then below 30 and then pops back above 30, that has coincided with some of the major bottoms that we've had going back over the last 18 months. And if you go back in previous cycles, you'll see some similarities there as well. If you look back here in May and June of last year, though, you'll find that we had a number of times we went below 30. We popped back up and then quickly went below. Or we ended up making a new low, went below 30. So not every signal means we're going to go up 5, 10% or some sort of particular attribution. But I would say in general, I have found it really good to know when the indicator goes below 30 because that tells me to look for and to wait for it to go back above 30. That is where we're at right now on the S&P 500 with its bullish percent index. So now that we have initiated this buy signal, I would say it could continue to go down for weeks. That has happened before. Look at September and October of last year. But when it goes back above 30, that's when it tells you we might be in the beginning of a recovery. So that's what I'd be looking for now on the chart of the bullish percent index. Chart number 2, great questions on divergences. I actually didn't know we were going to have those questions on divergences. So kind of funny that one of the 3 in 3 charts I picked before the show was looking at Hess. Hess is actually a buyout name. Where Chevron agreed to buy Hess. And again, we'll see if that actually is approved and everything. Hess down 1% on the news. But what I was looking at is from a technical perspective, this is a stock showing a clear bearish momentum divergence. New highs in August, September, October, met by lower momentum. That suggests the uptrend is in its later stages, and it tells me to start looking for signs of a breakdown. We may be beginning that now, but I would look to see if we can hold the 50-day. The 200-day moving average has been really the moving average to watch for stocks like Hess, some of your integrated oil companies as well. Finally, we highlighted in our market recap Bitcoin pushing above 31,000, which is the upper end of that trend channel we've been in for quite some time, or that basing pattern that we've been in. Look at the chart of Ethereum over the last 8 to 10 weeks. You can see it's settled into a range as well, around 1520, 1530 on the lower end, around 1750 on the upper end. So nice rally for Ether. Bitcoin is kind of up here, right? Bitcoin is testing new highs for the year. Ethereum a little bit lower. So Ether has been lagging behind Bitcoin, but I would say getting out of this basing pattern could be a really interesting buy signal. The 200-day moving average, by the way, would be the real signal I'd be looking for as well. So getting above 1785 could clear the way to a retest of the highs for 2023. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close for the final bar. Appreciate you so much joining in our live Q&A. We will keep the mailbag open, so get your questions to us via email this week. We'll do a mailbag segment on Friday, and we'd love to answer one of your questions on the air. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.